Hey, welcome. Today, we're diving into a financial strategy that really flips a familiar product on its head. It's called the Insured Retirement Plan, or IRP. It's a way to use life insurance not just for after you're gone, but as a source of tax-free income while you're still here. So let's dive in and see how this thing actually works.
So when I say life insurance, what's the first thing that pops into your head? For most of us, it's about making sure our loved ones are taken care of after we're gone, right? But what if that exact same policy could also provide for you during your retirement? What if it could become a stream of tax-free income that you could actually use?
And that right there is exactly where the Insured Retirement Plan comes into play. This strategy completely reframes life insurance. It goes from being just a simple protection tool to a really powerful asset you can use to build and access your wealth while you're still around to enjoy it.
So what exactly is an IRP? Well, first things first, it's crucial to understand that it's not a product you can just go out and buy. It's a strategy. It's a method for using a permanent life insurance policy to create a tax-advantaged income stream for your retirement. You can kind of think of it like a playbook for turning your life insurance into your own personal pension.
This strategy basically transforms a single policy into a triple-threat asset. First, it acts like a protected investment account where your money can grow, sheltered from tax. Second, it becomes a super tax-efficient source of income for you when you retire. And third, of course, it still does its main job, providing that guaranteed tax-free legacy for your family. It's doing 3 jobs at once. Pretty cool, right?
Okay, so to really wrap your head around how this all works, it helps to think about it as a journey. A journey with 3 very distinct phases that line up perfectly with the different stages of your life.
So here's what that roadmap looks like. First, you've got the accumulation phase, and that's happening during your working years. Then comes the harvest phase. This is when you retired and you want to start accessing that money. And finally, you have the settlement phase, which is all about making sure your legacy is passed on just the way you want.
All right, let's break down exactly how this cycle works, piece by piece. In the accumulation phase, you overfund your policy. That just means you pay more than the bare minimum premium. All that extra money gets funneled into a cash value account where it grows tax-deferred. Then when you retire, you hit the harvest phase. Now here's the key. Instead of withdrawing your money and getting hit with taxes, you take out a loan against that cash value, and that loan is tax-free. Finally, the settlement phase. When you pass away, the death benefit from the policy pays off the loan, and whatever's left over goes to your heirs, also tax-free. It's like a completely self-contained financial engine.
Now, of course, to make this whole thing go, you've got to have the right kind of engine under the hood. Not just any old life insurance policy is going to do the trick.
The IRP strategy only works with one type of insurance, permanent life insurance. And you might be asking, why is that? Well, it's because it's the only kind that gives you 2 absolutely essential features: coverage for your entire life, and, this is the big one, a savings or investment part called the cash value. That cash value is the heart of the whole strategy.
When we talk about permanent insurance for IRPs, there are 2 main players, universal life and whole life. With universal life, or UL, you get a lot more flexibility. You can adjust your payments and choose how your cash value is invested, but you also take on the investment risk. Whole life, on the other hand, is much more structured. You have fixed premiums, and the growth in your cash value is guaranteed. So you've got this trade-off, right? It's flexibility and control versus guarantees and certainty. The right one for you really depends on your own financial style.
And our source material makes a really key point here. If your number one goal is to build up as much cash value as you possibly can for retirement, then because of its flexibility and growth potential, a well-structured universal life policy is often the preferred tool for the job.
Okay, so we've talked about what this is, and we've walked through the phases. Now let's really get into the nuts and bolts, the 3 core components that make this whole thing tick: the death benefit, the cash value, and the policy loan.
All right, first up, you've got the death benefit. This is the lump sum that gets paid out to your beneficiaries. In an IRP, it plays a double role. It's the ultimate backstop. It guarantees that any loan you take in retirement gets paid back, and it makes sure a legacy is still left behind. It's really the bedrock of the entire structure. Next up is the cash value. This is the real engine room of the IRP. It's that investment part of the policy where your extra premium payments are growing. And honestly, the best way to picture this is as the fuel tank for your retirement. The more fuel you put in this tank over the years, the larger your borrowing capacity will be later on. Simple as that.
And that brings us to the third piece, the policy loan. This is the key to how you actually get your hands on the money. It's not a withdrawal. It's a loan you take from the insurance company, and you use your cash value as collateral. This makes it the perfect delivery mechanism for your retirement income, and the magic word here is that because it's a loan, it comes to you tax-free.
Okay, so let's tie this all together one more time. Look how beautifully this flows. Step 1, you overfund the policy. That leads to Step 2, building up a large cash value. That large cash value allows you to do Step 3, borrow against it using a policy loan for tax-free income. And finally, Step 4, the death benefit pays off that loan and the rest is a legacy. Each step just seamlessly enables the next.
Whew, okay, we have covered a ton of ground. So let's boil it all down to the key takeaways and talk a little bit about what comes next.
So after all that, why should you care? What's the bottom line here? Well, the benefits are pretty powerful. You get tax-deferred compound growth while you're working. Then, you get a potentially tax-free income stream when you retire. What's more, that income, since it's a loan, generally doesn't mess with your government benefits like old age security. And you still get to leave a tax-free legacy. It's just a remarkably efficient strategy.
Now, it is super important to remember this. An IRP is not some simple, off-the-shelf product. It's a pretty sophisticated strategy, and its success really hinges on it being structured properly from the get-go and requires a long-term commitment. This is definitely one of those things where you need to sit down with a professional, a good financial advisor, to see if it even makes sense for your situation.
And all of this really brings us to one final big question for you to think about. After seeing how all these pieces fit together, it's worth asking yourself, is your life insurance just sitting there waiting for the inevitable? Or could it be working harder for you right now? It's a powerful thought. Thanks for tuning in.